Okay, our next adjustment has to deal or will be dealing with depreciation. Now, depreciation is the loss of value of a fixed asset over time. Okay, a fixed asset is one of our larger assets, things like building, things like truck. Okay, so they're going to lose value over time. Now, the only asset that does not depreciate is land. Now, in grade 11, we are going to be discussing two different ways to depreciate assets. One is called the straight line method, and the other one is called the declining balance method. In grade 12, we discuss additional methods of depreciation, including units of output and some of the years. So let's get back to our example. Or On January 1st, 2008, we purchased $12,000 worth of equipment with an expected life of 5 years. The equipment is expected to have no salvage value. Salvage value is what we could sell it at, okay, after that 5 years. So really, it's not worth anything after 5 years. Okay, so it has no salvage value. Record the adjusting entry that would be recorded on December 31st, 2008, or the end of the fiscal period. Okay, so if we take 12,000 and we divide by 5 years, that's going to give us how much it loses value per year. Now, the adjustment for depreciation is always the same. It's going to be depreciation expense equipment debited and accumulated depreciation equipment credited. Now, these are two different types of accounts. Depreciation expense is an expense, and accumulated depreciation is a contra asset. So it's going to reduce it's going to reduce the value of another account, specifically equipment. So the equipment account is going to be going down due to accumulated depreciation. Now, accumulated depreciation, think of it as a bucket. So every time we depreciate something, the bucket's going to be filling up. Okay, so at the end of it all, the equipment's not going to be, well, in this example, the equipment's going to be worth nothing because my bucket's going to fill up to 12,000, right? So the original cost, 12,000 minus what will be in my bucket after 5 years, which will be 12,000. Okay, so the equipment will be worth nothing after 5 years. So, okay, a contra account, okay, like accumulated depreciation equipment, is going to reduce the original value, right? Or reduces another account, specifically in this case, equipment, okay? And we're going to see it on the balance sheet, but we'll get to that in a bit. All right, so what's the difference between the straight line method and the declining balance method? So you'll notice that there's a star here because it's important. Okay, now under the straight line method, the original cost of the asset is multiplied by the depreciation rate for the fiscal period to determine the amount of the adjustment. Or in a lot of cases, the accountant must use the following formula to calculate the annual depreciation or the yearly depreciation for that asset. So the original cost minus the salvage value divided by the estimated useful life of the asset. And that'll give you the annual depreciation. So this will make a little bit more sense with an example. So let's suppose we purchase equipment on January 1st for $10,000 with an estimated salvage value of $500 and an expected useful life of 5 years. Now, the adjusting entry is always going to be the same, remember, so you're going to have to memorize it. So depreciation expense equipment, because we're dealing with equipment, debited, and accumulated depreciation equipment credited. Now, if we were talking about car, we just replaced the word equipment with car. If we're talking about building, same thing. All right, so if we plug this into our formula, the original cost, 10,000 minus 500 divided by 5, you get only you get $1,900. So how in the heck am I getting 158.33? The reason is, okay, I have to now multiply that 1900 by 1 over 12 because I need 1 month's worth, or take that 1900 and divide by 12 because there's 12 months in a year. That's how I'm getting that 158.33. All right, so let's go to the second example. We purchased a car on January 1st for $20,000. The car depreciates at a rate of 5% per year. Using the straight line method of depreciation, determine the adjustment that would be made on January 31st. Assume there's no salvage value. So what we're going to do is we're going to take $20,000 and we're going to multiply by 0.05, right? 5% per year. Let me do it on the calculator. That's going to give us $1,000, okay? But that's for one entire year. You have to figure out how much it depreciates in 1 month. So if we divide by 12, we get 83.33. So again, on January 31st, we're going to make the following entry. Depreciation expense car debited for 83.33 and accumulated depreciation car credited for 83.33. Now let's talk about the second method of depreciation. Okay, under this method, the fixed assets are depreciated by an equal percentage per fiscal period based on the asset's book value. All right, that seems a little bit confusing, but it will make sense in a little bit. Okay. Now, salvage value is not taken into consideration when using this method, so don't subtract any salvage value. So we're going to be, for declining balance, as soon as you hear the fact you're using declining balance, you should say, I need the asset's book value. And the asset's book value is its original cost minus anything that's in accumulated depreciation already. So the general rule is, when using the declining balance method, is take original cost and subtract anything in the accumulated depreciation account and then multiply by the depreciation rate. So let's go through this example quickly. So we purchased a car on January 1st for $12,000. The car depreciates at a rate of 20% per year. Using the declining balance method of depreciation, determine the amount of adjustment that would be made December 31st for each of the first 5 years. So the book value at the beginning of the first year is $12,000, right? It's original cost minus accumulated depreciation, so it's $12,000. So for the amount of the depreciation for the current year is 12,000 times 20%, and it's going to give you $2,400, right? So that $2,400, that's the first time we depreciate, it goes in our bucket, it goes into accumulated depreciation. So at the end of the year, there's going to be $2,400 in our bucket in accumulated depreciation. So to start the second year, the book value, which is the original cost, minus what's in our bucket, gives us book value. So we take the book value now and multiply by 20%, and that's going to give us 1920. That 1920 now goes into our bucket. So our bucket now has this plus this for a grand total of this. Okay, so starting the third year, our book value, which are original cost, which was $12,000, minus what's in my bucket, gives us $7,680. When I multiply by the depreciation rate, you'll see that it becomes $1,536. So you'll notice that depreciation is changing every year, okay, because we're using the declining balance method. So that's what this is trying to explain up here by an equal percentage. Okay, so as you see in this column, the book value is decreasing and approaching zero as the asset gets older. The amount of depreciation is higher in the early years and gets lower and lower as the asset ages. So it's approaching zero as well. Now, what's happening to my bucket? You'll notice my bucket is going to fill up. Okay, so it's going to fill up to, in this example, $12,000. Okay, now here we go. Every adjusting entry affects a balance sheet account and an income statement account. So if you think about it, okay, we started off with prepaid expenses. So rent expense debited, that's an income statement account, and prepaid rent credited, that's a balance sheet account. So for supplies, it's supplies expense, which is an income statement account, and supplies, which is a balance sheet account. For depreciation, it's depreciation expense building, so that's an expense, it's an income statement account, and accumulated depreciation building, which is a contra asset, which will go on the balance sheet. All right, note number 2. Okay, the straight line method will give you a depreciation figure that stays the same every year, but as we saw in that last example, okay, the declining balance method, okay, produces depreciation figures that are higher in the early years and lower as in the later years as the asset ages. Now, Canada Customs and Revenue normally requires companies to use the declining balance method for depreciation, okay, when completing their income tax forms. But in some cases, okay, you can use the straight line method, okay? Now, we're not going to worry about late arriving invoices, so you don't have to worry about that, okay?